Compound growth is one of the most powerful concepts you can understand to help you make better decisions when you're making an investment decision. Compounding involves earning returns on both your original investment and returns on your received previously. This means you need to reinvest your returns back into your account. For example, you invest $10,000 in a stock, you earn a 5% dividend in the first year, you'd make 500 bucks. If you put it back in your investments instead of cashing it out, that would bring your total investment to $10,500. Next year, if the dividend remains 500, you'll earn an extra 525. Now your investment's at $11,025. Over the long term, compound growth can multiply your initial investment exponentially. In our hypothetical example, if your returns stayed at 5%, by year 20, your total investment that started at $10,000 would be worth $25,000. And that's only $10,000 we're talking about. That's more than 100% return just by sitting by and letting your money grow. The secret is patience. Don't be tempted to withdraw the funds when they grow. There's two things you need to keep in mind before you go looking for stocks that pay dividends. First is taxes. Keep in mind that if you hold your investments in a taxable account, you'll still be taxed on the interest, dividends, and capital gains you receive, even if you reinvest them in the account when you cash it out. Many people don't feel good about having to pay taxes for the gains, but there is a way around it. Open a Roth self-directed IRA or a Roth, which is called a Roth IRA. You'll pay taxes when you put the money in, but not on your capital gains. You can put many kinds of assets in a self-directed IRA, including stocks, real estate, and precious metals. Second, like any other asset, an asset could tank. Even the most established brands could fall. If that happens, your stocks could go down. Third, and probably most important to consider, is inflation. Our current inflation is at a high of 6%, but analysts are saying real inflation is north of 13%. That means for you to maintain the value of your investment, listen closely, this is just to maintain the value of your investment, never mind growing, you need to make more than inflation. If inflation is at 13%, then your gains need to be at 13% for the month. I can tell you this much, it'll be very hard to find stocks that give more than 5% dividend return per year. They're out there, I'm telling you, you can find them, but they're risky ones. The safe ones, 5% or lower, GE, some of the big guys are at 2 to 3%. Now, I'm not saying you should invest in stock. In fact, it is the opposite. You need to diversify your investments, and stocks should be one of the investments. But you also need an asset that's gonna hedge. In other words, you gotta look at gold. You gotta have the risky things, you gotta have some dividends, you gotta have something that's the last line of defense. Real estate has often been considered a hedge, but there's nothing better than gold. Holding some gold in your portfolio gives you assurance that when everything else goes down, you'll have one asset that goes up. Gold has historically gone in the other direction as the market. When the market goes down, gold goes up. If the market is going up, gold is typically more steady. We suggest you consult your financial advisor, but when you're ready to invest in physical gold, silver, platinum, palladium, give us a call, 877-646-5347. If you're interested in investing in precious metals and you want to talk to a no-hassle representative that has experience in physical metal, give us a call. Phone number is 877-646-5347. Our phone lines are always open, and we're happy to answer any of your questions.